Imagine walking into, like, a sprawling, chaotic, open-air marketplace.
Oh, yeah, like a total bazaar.
Exactly. There are thousands of stalls, thousands of items, and every single one has a price tag attached. But here is the trick to surviving this place.
You can't trust the tags.
Right. Not a single one of those price tags is tied to objective reality. They're basically just the seller's fantasy.
Yeah, just a number they dreamed up that morning while having their coffee.
You might look at a relatively common item, and the tag says $1 million.
Mm-hmm.
And then you look at a genuinely rare artifact, and, the tag says $10.
It's wild.
It is. So how do you find the real value in an environment like that? How do you figure out who is actually ready to negotiate and who is just, treating their inventory like a lottery ticket?
That is the big question.
Right. So we are jumping into the Solana domain market today. And our mission for this deep dive is to equip you with the ability to read seller intent and decode the hidden signals in this digital bazaar.
Which is so needed because it's a market that completely breaks our standard retail conditioning.
Oh, completely.
We are so used to believing that a price tag is, the objective truth of what an asset costs. But here, you have to look right past the surface numbers to figure out what the person on the other side of the screen is actually thinking.
And before we get into the weeds of how to do exactly that, this deep dive is brought to you by Negotiate.name.
A very fitting sponsor for today.
Seriously, it's the simple way to bid on over 5,000 Solana domains, with new names added daily and user listings available to browse, too. You can make unlimited offers on premium.sol names without locking up your Solana.
Which is huge for liquidity.
Exactly. You can see what you can negotiate and discover names before the rest of the market does. And if you own premium Solana domains, you can submit your names for sale while keeping your contact information private.
Privacy is always a plus.
Yeah. Negotiate.name helps broker the conversation so buyers are not sending offers into the void and sellers are not missing serious inquiries that sit unseen for months.
Which honestly ties perfectly into the core problem we are unpacking today.
It really does. Okay, let's unpack this, because there is a massive, often invisible gap between what a seller initially asks for and where a transaction is actually going to clear.
Right. Most people browsing these marketplaces, they just cannot tell the difference between static inventory and true market intent.
They treat every single listing as if it carries the exact same weight. But a domain listing in this market is not a sale.
No, not at all.
It's not market proof of any underlying value. It is strictly an ask.
Yeah, it's just a request.
Right. A seller can list a Solana domain for 10 SOL, 50 SOL, 100, or 1,000. There's basically zero friction to doing so.
They just type the number in and hit approve?
Exactly. They do it because they believe their name is premium, or they believe a natural buyer will eventually show up and, pay whatever ransom they demand.
And until that buyer actually materializes and executes a transaction, that listing remains entirely unproven. It's fiction.
Total fiction. So if you are only browsing current listings, you really have to operate under the assumption that you are looking at a catalog of seller hopes.
Yes, seller hopes. I love that term. Because some of those asks are, calculated based on historical data.
Sure.
But many are priced purely on emotion. Others leave a massive buffer for negotiation. And a really significant portion are priced by sellers who don't even care if the asset sells.
Right. They just throw a moon math number on it so they don't have to monitor it.
Exactly. They list it for 1,000 SOL and go back to sleep.
Okay. But if the asking price is just a fantasy, standard crypto logic would dictate that buyers should just look at the floor price.
Right?
You would think so, yeah.
Like, if the individual asks are detached from reality, shouldn't I just filter by the absolute cheapest .sol domain available to find the true baseline value?
That approach completely falls apart when you're dealing with premium, non-fungible assets.
Yeah. Sweeping the floor works when you are trading fungible tokens where one asset is identical to the next. But a floor price for domains, it just shows you the cheapest, most undesirable inventory in a massive sea of assets.
Oh, so it's just the bargain bin.
Exactly.
Okay.
It is totally blind to category demand. It tells you nothing about seller behavior. And crucially, it doesn't alert you when a specific high-quality premium name suddenly becomes buyable.
Right, because the premium name is never going to be at the absolute floor anyway.
Never. You cannot evaluate a premium asset by studying the cheapest junk in the market.
Okay, that makes sense. So the initial asking price is a fantasy, and the floor price is basically just noise for premium buyers.
Right.
We clearly need a different metric for reality. We need to look at movement.
Yes. What's fascinating here is that markets are not static catalogs. They're essentially continuous expressions of human behavior.
Okay, break that down for me.
So consider a Solana domain listed at 10 SOL that just sits there for 6 months. That static state is data. But if a domain is listed at 10 SOL yesterday and then drops to 6 SOL today, the domain itself hasn't changed.
Right, the letters are the same.
The underlying asset is identical. But the seller's behavior just underwent a drastic shift.
And that shift is the intent we are looking for. The asset just transitioned from being static inventory to a live opportunity.
Exactly. The psychology driving that drop is what really matters.
Right, like maybe the seller is watching Solana pump and wants to free up their capital to rotate into meme coins or something.
Oh, that happens all the time.
Or maybe they have a real-life liquidity crunch. Maybe they finally capitulated after looking at actual comps and decided to get realistic. Or, maybe they just want to start a negotiation.
Yeah, to invite a counteroffer. Regardless of the specific catalyst, the overarching reality is that the seller is now engaged.
They're active.
Right. In these domain markets, a massive percentage of holders are entirely passive. They register a name, list it at an arbitrary multiple, and go to sleep.
They just forget about it.
Pretty much. They don't update prices. They ignore inbound offers. They are frozen. So an active seller who drops the price is signaling that they are awake and paying attention to their portfolio.
But wait, let's play devil's advocate for a second. Let's define what actually constitutes a signal here.
Okay, let's do it.
Because if a seller drops their price from, say, 2.0 SOL down to 1.99999 SOL, that is technically movement.
Right. Technically, sure.
But it doesn't exactly feel like a capitulation or a sudden need for liquidity.
No, not at all. That is just algorithm gaming. A tiny fractional price move is just noise.
So it's meaningless.
Completely. It might be a seller trying to bump their listing to the top of a recently updated sort on a marketplace, or, algorithmic pricing bots fighting over pennies to be the lowest in a specific micro category.
Right, just playing with numbers.
Yeah, it tells you absolutely nothing about their underlying motivation to make an actual deal.
So a real signal requires a massive adjustment, a structural change, going from 20 SOL down to 12, 10 down to 5. Or like a completely unrealistic listing slashing from 100 down to 60.
Yes. That level of movement indicates the seller has swallowed their pride and made a painful adjustment.
It fundamentally alters the context of the asset.
It really does. A listing that has been stale for months, completely ignored by the market, suddenly deserves a second look when that kind of haircut happens.
It is the exact same dynamic as tracking a dormant crypto wallet.
Oh, that's a great comparison.
Right. If you are watching a whale wallet that hasn't made a single transaction in 14 months, and suddenly it wakes up and starts buying a specific token, the entire market pays attention.
Immediate alerts everywhere.
Exactly. It is a massive sign of life. A static domain listing taking a 50% price cut is the domain market equivalent of that. The seller is awake.
And if you extrapolate that logic, it really becomes about optimizing your own time and capital.
How so?
Well, buyers do not just want premium names. They need sellers who possess the capacity to actually sell.
Oh, that makes sense. You need someone willing to play ball.
Right. You can burn weeks trying to grind down a passive holder who refuses to budge, or you can focus your liquidity on the listings where the seller is actively broadcasting their flexibility.
Here's where it gets really interesting, though. Let's zoom out from the individual seller. Watching one person drop their price is useful, but observing multiple meaningful price drops across the broader market.
That's the holy grail.
Yeah. That is where you start to map out category pressure. This is where market intelligence stops being a neat trick and becomes a tangible edge.
Because category pressure reveals the underlying narrative shifts before they show up in overall volume metrics.
Exactly. Let's look at some examples. If you notice a sudden cluster of massive price drops across, say, meme names, like anything related to dogs, cats, or whatever the current meta is, that tells you the broader narrative is cooling.
The hype is fading.
Right. Holders are realizing that demand is evaporating, supply is bloated, and they are all rushing to find the new clearing price before liquidity disappears entirely.
But if you contrast that with a category like payment names, domains built for wallet apps, merchant tools, creators, or stablecoin projects, and you see those prices holding firm while the rest of the market takes a haircut.
That indicates deep conviction.
Exactly. Those holders believe their assets have intrinsic long-term utility that insulates them from temporary market shifts.
Or look at the AI Asian category. If you are tracking that sector and you see a massive influx of new listings, but absolutely zero meaningful price drops, that paints a very specific picture.
Oh, totally. People are rushing to mint and list because they think they struck oil.
Right. But nobody has felt the pressure to capitulate yet. They're holding out for, like, enterprise software money.
Yeah, they're waiting for a big tech buyout.
And short names, too. Your 3 or 4-letter .sols, they almost never see drastic price cuts. They have a baseline collector value that makes the holder base incredibly stubborn.
They really do. But, and this is crucial, realizing any of this requires a concept that most casual market participants entirely lack, and that is market memory.
Market memory. Okay, explain that.
Well, the reason the average browser misses category pressure and completely misses individual price drops is because traditional marketplaces only show you the present moment.
Right. You log in, you see a domain for 10 SOL, and you have absolutely no context for how it got there.
None. You don't know if the seller minted it yesterday and listed it for 10 immediately, or if it was listed at 50 SOL for 2 years and they just capitulated an hour ago.
You are essentially flying blind in a market where the historical charts have just been erased.
Exactly. Without memory, the market looks flat. You cannot interpret behavior if you only have one single data point.
So how is a buyer actually supposed to track all this without going crazy checking thousands of names every day?
That's where you need a market insights layer. Basically, a database that continuously takes snapshots and tracks these deltas.
So it does the memory work for you.
Right. Operating without that leaves you at a massive disadvantage. You need infrastructure that filters out the noise, ignores the fractional algorithm gaming we talked about, and isolates the meaningful adjustments.
And it doesn't need to be overly complex either. A good price drop page should be simple.
Very simple.
You just need to know the domain name, the previous price, the new price, the percentage of the drop, the category it belongs to, and where to act.
Yeah, just the vital stats.
When you aggregate that, the market stops looking like a static catalog and starts telling you a very clear story about human behavior and capital flow.
And I need to hit the brakes here. We need to establish a very hard boundary.
Uh-oh. The warning label.
Exactly, because the immediate danger of acquiring market memory is that a buyer will boot up an insights page, see a premium-sounding name that just dropped from 50 SOL down to 10 SOL, and immediately execute the transaction.
Just because they were mesmerized by an 80% discount.
Yes, the discount trap. I have to say this.
Yeah.
Cheap is not the same as undervalued.
That is a hard truth.
It is the single most destructive misconception in these markets. A bad name at an 80% discount, or even a 90% discount, is still a fundamentally bad name.
But wait, if it's heavily discounted, isn't there an argument for scooping it up just for the arbitrage opportunity? I mean, if someone slashes a long, hyphenated, confusing phrase by half price, they're practically giving it away.
The problem with that logic is that liquidity in the domain market is not guaranteed.
Right, it's not a liquid token.
Exactly. If a seller registers a forced meme name that has no cultural resonance or some complicated string of characters that is a nightmare to spell, it doesn't matter how cheap it gets.
And because nobody wants it.
Right. It is not worth owning because you will never find a secondary buyer. You aren't getting a deal. You are just volunteering to hold their dead weight.
Okay, which means we need a final filter. You see the massive price drop, you verify it as a meaningful behavioral signal, but before you deploy capital, you have to run it through what we call the natural buyer test.
Yes, the
Yeah.
ultimate filter.
You have to look at the asset and ask, who eventually wants this name?
Right. If you cannot instantly visualize the exact type of user, company, or protocol that would naturally want to acquire that specific domain, you just close the tab and walk away.
So a price drop without a clear natural buyer is just a cheaper listing of a toxic asset.
That's exactly what it is.
Let's run through the archetypes to make
Yeah.
this concrete for the listeners. Take a trading name. The natural buyer pool is obvious.
Oh, very obvious.
It appeals to public crypto traders, signal groups, algorithmic bot builders, wallet tracking dashboards, or degen lifestyle brands. That is a defined demographic with actual capital.
And then look at a payment name. That has an even more institutional natural buyer.
Like who?
You are looking at wallet infrastructure teams, merchant checkout protocols, creators who just need a clean tipping address, or emerging stablecoin issuers.
Right, or an AI agent name. That naturally targets software developers or teams deploying autonomous on-chain agents. And the short names, the common first names or three-letter strings, they have the widest net of all. They appeal to individual collectors, massive Web2 brands migrating on-chain, or just wealthy individuals who want a premium identity.
And this test, this natural buyer test, determines whether the discount is real or a mirage.
So if the biopool is obvious, it's an opportunity.
All right, if the buyer pool is robust and the name itself is clean, memorable, and lacks hyphens or weird spellings, then a sudden capitulation in price is exactly the signal you want to act on.
It means a high-quality asset is entering a reasonable valuation range simply because the current holder needs liquidity.
Spot on, but if the buyer pool is unclear or ambiguous, the discount is a trap.
So what does this all mean for the buyer? The practical application for anyone navigating this space is to treat a meaningful price drop as a watch list signal, not an automatic buy button.
Yes, a watch list trigger. It is a filter that separates the active market from the frozen inventory.
Right. Once it hits your radar, you apply the natural buyer test. And if it passes, you don't necessarily just pay the new asking price anyway. You treat it as an open invitation to negotiate.
Because the seller has already blinked.
Right.
They have publicly signaled their flexibility by abandoning their initial fantasy valuation. I mean, if they were willing to manually adjust their listing from 10 SOL down to 6, they have already absorbed the psychological blow of taking less.
So they might take even less.
Exactly. That means they are highly likely to entertain a firm liquid offer of, say, 5. The drop is just the beginning of a conversation.
The best assets in these markets rarely sell at the listed price anyway. They clear through direct negotiation once the seller signals they are ready to talk.
Exactly.
Pulling this all together, it completely changes how you have to view the Solana domain market. The static inventory you see when you blindly scroll a marketplace is nothing more than a collective wish list.
Just sellers dreaming out loud.
All right, real market intelligence comes from watching behavior, movement, and intent. When you combine a massive behavioral price drop with a strong natural buyer, that creates the ultimate setup. You've isolated the true signal in the noise.
You really transition from analyzing numbers on a screen to analyzing the underlying human psychology driving those numbers.
It's a total mindset shift.
It is. And, consider what that actually means for how you operate outside of crypto.
I like where this is going.
Well, think about it. We have spent this entire deep dive dissecting how a price drop exposes the hidden intent of a digital asset seller. But look at the other supposedly static markets in your life.
Like what? Real estate?
Yeah, real estate. Think about a house listing that has been sitting untouched for 8 months, or think about the initial salary band a recruiter offers you during a hiring process.
Oh, yeah.
Or even the renewal rate on a massive enterprise software contract, or like a subscription renewal. Where else are you mistakenly accepting a static asking price as an unmovable objective reality?
When you should really be hunting for the behavioral signals in historical movement.
Exactly. Those signals reveal what the other side is actually willing, or even desperate, to accept.
That is such a good point. The world is built on fantasy price tags, and most people never realize they're allowed to look past them. Keep tracking the movement, and we will catch you on the next deep dive.